All right, guys, let's quickly take a look at NFP coming up a little bit later. As always, a key macro event we need to keep on our radars. We don't always get great tradable opportunities out of NFP, but when the stars align, when we get some very, very decent deviations in the right direction, that is, it can create some fantastic tradable opportunities for us because it has a lot of momentum behind it. There's a lot of volatility coming into the markets during NFP. So it's definitely one we always need to watch. Now, coming into this week's one, there's a little bit more attention than usual on this labor data print because even though we had some solid PMI data last week for the ISM services and manufacturing, the labor data we had last week was a little bit bad, right? We had ADP national employment printing at 22,000 versus market expectations of 48 at the time. Very, very close to the market's minimum expectations. We also had job opening data falling all the way to 6.5 million, which was the lowest since COVID. So the fact that the growth data came in good, but the labor data, pointed to possible warning lights, that has put today's print on a little bit of a pedestal in terms of importance. Apart from that, what did the Fed tell us at their prior meeting? During their prior meeting, the Fed told us that, listen, we think that the overall data that we've had so far shows us that the labor market, the prior stress that they thought was in the labor market, and remember, that was one of the main reasons why they cut rates in the first place last year, they told us that they think that some of those initial stresses have now subsided and they see stabilization in the labor market. Now, as a result of that, the markets have been comfortable in not pricing in more than 2 cuts this year. We are currently sitting at 60 after last week's jobs data and obviously after yesterday's ugly retail sales data that we had. But so far, the markets are only pricing in 2 cuts. Now, what does that mean for us for today's print? Well, it's obvious. If we see jobs data coming in very, very ugly, meaning that the Fed is not correct, the markets will very quickly start pricing in 3 potential cuts for the FOMC by the end of the year, and that could translate into even more downside for the US dollar. Vice versa, if the Fed is right and today's data comes out telling us that everything is okay, the job opening data and the ADP data was just a one-off and the labor market is still doing fine, then there's no reason for them to push for that additional cut. From a market's point of view, the market's probably then prices out that additional 10 basis points that we've been pricing in, and that could see us drifting back down to 50 basis points implied for cuts by the end of the year, and that should be all else equals dollar positive in the short term. The other reason why today's print is a little bit interesting is we had some interesting comments coming out from Navarro as well as Hassett this week, who've basically been tilting or guiding the markets towards a softer print. We had Hassett coming out saying that we shouldn't be surprised if labor, comes out ugly in the next couple of months because of what's happening with the immigration policy. Same story with Navarro coming out saying that we need to revise what we see as a good labor market because millions of people are basically leaving or asked to leave from an immigration point of view. So that makes the print a little bit more interesting today because if they are right, like what type of number are we looking at, right? Are they trying to prep the markets to be prepared for a negative print? Is it just going to miss expectations? We don't know what they saw, and that means their comments are interesting, and it puts a little bit more emphasis on this NFP print for today. Now, as always, when we trade something, especially an economic data point, you absolutely need to know what you are trading, right? You have to understand the indicator that you are trading. When it comes to NFP specifically, yes, the first initial reaction always takes place out of the NFP itself with the jobs numbers. But the markets very quickly turn their attention away from just NFP and assess the labor market as a whole, right? What is the entire report telling us? That means that we can't just focus on what the NFP itself tells us. We also need to make sure to check what the unemployment rate is telling us. What is earnings telling us? The jobs market as a whole, NFP, unemployment, and earnings. That is what we want to see. And our best chance for success when we want to trade something like this is we want to see all 3 of those key metrics showing us more or less the same thing. For example, if NFP comes in really, really bad, we don't want to see the unemployment rate coming in really good, meaning lower, right? If NFP shows us a massive miss in jobs, we want to see the unemployment rate ticking up. We want to see earnings ticking down as well, right? We want to make sure that whenever we see an ugly print, for NFP, we want to see it follow through in the labor data. Vice versa, if we are seeing a solid beat in NFP at the headline, we don't want to be trading this if the unemployment rate is ticking higher. We want to trade this if the jobs data is showing us solid data. We want to see the unemployment rate ticking lower. We want to see earnings ticking up. We want everything in the print to tell us good or everything in the print to tell us bad. You don't want any ambiguity when you're trading these things. You don't want to give the market an out in terms of directional flow. You want to see that type of print where if you see it, you're like, man, that was a really good print, or man, that was a really bad print. You don't want to be thinking about it. You want to know, yes, that was ugly, it should be dollar negative, or yes, that was really good, it should be dollar positive in the short term. The other thing to keep in mind is when it comes to the reason why we can have these divergences, right? Why you could have NFP coming in super low and the unemployment rate coming in low as well. The reason why you can have that divergence is because these two things, non-farm and the unemployment rate, come from different reports, right? You have your household survey, which is where we get the unemployment rate from. And then you have the establishment survey, which is where we get the jobs data from. So don't be surprised. It's not unheard of for this to print, -10 and the unemployment rate to actually tick down. It has happened before. Or to see huge amounts of jobs being added, but the unemployment rate actually ticking up. Obviously, we need to watch for things like participation as well. If participation is much higher, or lower, that can influence the unemployment rate. But bottom line is, don't be surprised if these two things differ. They differ all the time. We want to look and wait for those prints where everything is giving us the same message. So with that said, what type of numbers are we looking for to potentially surprise the markets today? Now, it's interesting because expectations is for 70, right? But because of the commentary that we've had from Hassett and Navarro this week, the markets are arguably already leaning towards the likelihood of a softer print, right? There's been other things driving the dollar lower, no doubt. But I do think that some of this week's weakness has been those guidance saying that, maybe jobs isn't looking as great. We need to prepare ourselves for ugly numbers. Like, what are we talking about here, right? So the dollar has been weaker on the back of that. So in my opinion, even though consensus is 70, it's tough knowing what they would see as a bad print, right? What did Hassett see? What did Navarro see? Are we talking negative numbers? Are we just talking very low numbers? If expectations was 70 and you have somebody like Navarro coming out saying that we need to drastically revise what we see as a good jobs number, I mean, how bad is it, guys? You know what I mean? So in terms of 70 as a consensus, I think we are probably closer towards 50, maybe even 40 in terms of the whisper number. I haven't seen the whisper number or numbers being touted yet, but I would assume that it is much lower compared to where we were now. I think as a soft estimate, let's use the prior of 50 as a closer to reality estimate going into this, right? That means that normally I would be happy with just a low NFP. But this time round, I think for me to want to be able to have confidence in chasing the dollar lower here and really trading it lower with confidence, especially with positioning in mind, which we'll look at in a second, I really want to see an ugly number. I want to see something that goes negative. I want to see a contraction in NFP. If we see a negative number, I think that is just it's the simplest way for us to expect downside in the US dollar. Similarly, if you take a look at where we are from a forecast distribution point of view, it's the only negative print that we had, right? So even something that's just marginally negative, I obviously put -10, but even if it's -5 or -2, anything below 0 will be a very big surprise because it's literally one participant, just standard chartered, that is looking for a negative number. Everybody else is looking for a positive NFP print. So keep that in mind. Anything negative, I think, is the type of miss that we are looking for to really surprise. Because remember, they've already guided the markets down towards a lower number. Vice versa, because the markets are, in my opinion, guided towards a softer number today, it means that we probably don't have to see something above the 135 maximum to really surprise the markets here. I think if we get anything that is above consensus, it's already going to be a big surprise because they've guided markets down, right? So anything that's above 70, so 75, 80, anything that's above consensus, I think will be seen as a very decent print today. What about the unemployment rate? Very simple there. Expectations is 4.4. Prior was 4.4. If we take a look at the forecast distribution, no craziness there in terms of tails. We've got a couple looking for 4.3, couple of looking for 4.5. So I think comfortably, I would be happy with the 4.6 above the max and prior. As a miss, I'll be happy with the 4.3 below the prior, and obviously below consensus as well. I think that'll be a good number. That'll be seen as a bad number. For earnings, once again, super simple here. We can see that minimum estimate is 0.2, so I'll be happy with 0.1 as a miss. For the beat, because there's only one participant that is looking for 0.5, I'll be happy with 0.5 or higher as a possible beat on that one. In terms of the year-over-year number, again, keeping it super simple here, minimum is 3.5, maximum 3.8. So I will be very happy to look for anything outside that spectrum. 3.4 as a miss, 3.9 as a beat. Really nothing fancy, super simple numbers, very clear reasons why. In terms of possible reactions, if it's a dovish outcome, what would we expect? Dollar down, yields down. Equities is a question mark, and you would expect some strength for gold. Why is equities a question mark? Well, because I don't know how they're going to react. Quite simply, I mean, should it be good news? Should it be bad news? You can argue for both, right? I'm not sure whether we are in a good data is bad news or good data is good news regime. I just don't know, because we've had the markets react differently. When we had solid growth data, we saw technology push lower, but we saw small caps doing really well. Then we had bad data, which saw both of them push lower. I think if you put a gun against my head and say, how will equities react? I think if it's a super bad print, I don't think equities are going to like that. If it's a really hot print, I think equities will like that. But I think there's a simpler thing to trade, and that's the dollar. I don't think equities, we need to force ourselves into a narrative like, oh, but it should be good, but it should be bad. But what about rate cuts? And it would be this, and then the Fed, and then, whenever I have to try and figure that out for more than 2 seconds, I'm just going to leave us. Like, why do it to yourself? Trade the thing that you have the most confidence in. And right now, I think that is the US dollar. So in terms of functionality, I'm not sure about equities. I just don't know how they're going to react. How I would expect gold to act if it's a solid print, downside. If it's a bad print, upside. But even then, gold has been so super volatile recently, with volatility still so high. That is what I would normally expect from gold, but I wouldn't have confidence in trying to trade that right now based on the amount of volatility that we've seen. I think the simplest thing for me will just be sticking to FX. Now, before we get to the actual possible scenarios that I'm looking at, a couple of other nuances just to keep in mind. We spoke about this during the week ahead as well. That is positioning. The dollar right now is fairly stretched on the short side for positioning. If we go to dollar aggregate here we go. We can see that the markets have piled into fresh shorts. Lots of reasons why, obviously. We've spoken about these recently. It makes sense. But the dollar is now in stretched short territory. Now, this does not mean because it is stretched, we want to just go out and buy it. That is a bad strategy most of the time. The reason why we focus on this in the first place is that if we are to see a solid print, this type of positioning data tells us that if we were to see a good print, because the markets are then offside in their positioning, it would arguably create a much more volatile move if it's good numbers compared to bad numbers, especially after the White House has guided the numbers down as well. So positioning means that, wow, if it is a super hot number, I would expect a slightly bigger reaction from the dollar. It also is the reason why, if you take a look at my expectations or my scenario planning, that's also the reason why I want to see a lot more pain for me to chase this. Because the markets are already short, I need to see the type of number that will make me go, wow, even though they are short, they probably will disregard this because that's a freaking ugly print. They want to chase the dollar lower if it's bad enough. So keep that in mind. Now, regardless of positioning, if the Fed is proven wrong, and the job market cools rapidly, i.e. we start seeing negative contraction in the labor market, then it doesn't matter that positioning is stretched. The dollar can still see more downside. That is the only opportunity, though, that I would be looking for downside for the dollar because of how stretched positioning is. So those are just two key things to keep in mind before we look at the scenarios. Now, Possible trades I'm looking at, if it's a super bad print that looks something like this, I'll be looking for dollar yen downside, Kiwi dollar upside. Why dollar yen? Well, just look at what the yen has been doing this week. I mean, what a massive surprise. Coming into the week, I was expecting dollar yen to push up. I was expecting us to start worrying about intervention. And when we get to 159, and is it 159? Is it 159.50? I mean, it literally went up a little bit, and it's been a one-way train to the downside. Now, we spoke about this in the channel as well, said that the ultimate pain trade would be for this thing to pop up a little bit and then just smash lower, and that's exactly what happened. Now, I didn't know this was going to happen, right? But it is the obvious pain trade right now because everybody expected it to go up, including me, right? I never wanted to trade dollar yen higher out of the election. The Nikkei has been, and still in my opinion, is the simplest way to trade this, or to trade that fiscal expectations. But, you know, you can't ignore a chart like this. So dollar yen, I think downside, if we see an ugly print, if we see a contraction, geez, I think dollar yen looks really attractive. The yen is absolutely firing on all cylinders right now. You've got hedge funds who are positioned in the opposite direction. It just makes a lot of sense. So in terms of what I would target, look, I think that low from the intervention low around 152, I think that's too soft, to be honest. If it's a contraction, geez, I'll be aiming for something much lower. I think something like 149.50 could be on the cards fairly easily. I know it's quite a distance, but think about it. You've got a super strong currency in the form of the yen right now. You've got concerns about, if you see renewed concerns about the labor market, and if you see pricing expectations for cuts increasing, I mean, we could be down there very, very quickly, right? So obviously look at the 152, look at the 151, look at those round numbers. But ultimately, I think a push back down towards that low from the 17th of October around 149.50, that does look like a fairly attractive area to target to the downside if it is an ugly print. The other one that I like right now is the Kiwi. Now, I've spoken a lot about the Kiwi. I'm not going to go into the fundamental reasons why we like this. That should be clear to everybody at this stage. What I like about this is we are knocking on that resistance right now. We've tried multiple times to break and stay above that 61 psychological level, 60-80, if you will, that entire area. And take a look at this. This is something that I like. If you take a look at what positioning markets have done, or retail positioning has done, they are short this market. That is what we want to see. Not aggressively so. I would have liked it to see closer to what it was a month ago. But the fact that we are moving in, what are they thinking, right? They are not looking at the NFP. They are not looking at the Fed. They are not looking at the growth potential for the Kiwi and the central bank divergence. They don't care about any of that. What are they looking at? They're like, oh, wow, we had resistance, 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 resistance. I'm going to sell this if we get to resistance. So they've been piling into shorts in anticipation of a push lower. So the obvious beautiful trigger that we can wait for is if it's a super bad number, we see a break above that level, we get a little bit of a liquidity pocket with all of the stops sitting there, and we can ride the sucker a lot higher. If it's a super ugly print, obviously that 62.10 has been a key level. That'll be a first area that I would look to target, and then above that potentially move back up towards 63.70. Also, what I like about the Kiwi, just quickly mentioning that again, is take a look at where positioning is sitting right now. Institutions are nowhere close to bullish this thing. And that is before, I mean, consider how much upside we've seen for the Kiwi already, and they are not yet bullish. I think there's a lot of upside there if it's an ugly number. So Kiwi dollar, definitely one to watch, and then dollar yen downside as well. The other one that I'm keeping on the radar in the event of a super good print or hawkish print, if we get one, pound dollar, frustratingly, and then potentially dollar CAD long. Now, I'm not a huge fan of either one of these two things. Why? Because the pound dollar, I got my ass handed to me with the pound dollar, right? I expected more downside. I basically chose the slowest horse in the barn for this race because take a look at, I mean, pound Kiwi smashed lower, pound Aussie smashed lower, even euro for Pete's sake, even euro sterling managed to push up and had some decent volatility, and the pound dollar just didn't do it because the dollar weakened. So I still like the pound lower. If it's a super hot number and the dollar bounce, that is the one currency that I would like to trade it against, right? I still think there's more downside to be had. You've got the dovish Bank of England, you've got the political situation. I see no reason for this thing to be trading at these levels, and I'll be looking for some downside reluctantly, right? Definitely not something that I like here, because from a momentum point of view, this is still a pretty bullish run. So keep that in mind. Also, what I don't like about this is from a positioning point of view, if you take a look at what retail has done, I don't like to trade in line with these guys, right? Look at this. They are slightly more short than long. I would want to see this. I want to see them super long for me to get on the short side, right? So the fact that they don't know, I don't like that. The other one that we could potentially look at, and this will just be a pure mean reversion positioning play, is dollar CAD longs. I don't like the CAD right now. I think the economy has been showing signs of stress, but compared to the Canadian economy, compared to the US economy, I don't see a good reason for the dollar CAD to be trading down to these levels. I honestly don't. From a central bank point of view, from a growth point of view, from an inflation point of view, I don't see good reasons for this to be trading here. But take a look at this. Retail is long. They are up to their eyeballs in longs on the dollar CAD. That is probably why it continues drifting lower. So I hate being long something alongside the retail crowd here. But what I do like about this, apart from retail being, on the wrong side of this move, is if you take a look at institutional positioning, they've gone bonkers with the Canadian dollar for a reason that I just cannot understand. Take a look at positioning. Yeah, why? Why would you go that aggressive on the long side? Anyway, this for me is a good enough reason to look for some mean reversion for the dollar CAD. Again, it's not things that I particularly like very much right now. I'm concerned about the dollar. But if it's a super hot number, those are probably the two things that I would like to trade purely from a positioning point of view, looking at that. Now, the other thing that we can quickly look at here that I also like about pound dollar downside, again, if we get a big enough miss there, let me just show you guys what I'm talking about, is the options market is not convinced with this move higher in pound dollar. And if we do this, take a look at that. The options market risk reversals has not bought into this recovery in the pound dollar. I think for the same reason that we are not, right? We think that the pound should be lower. I basically just chose the exact opposite thing to trade, or the worst thing to trade on that front. So bottom line, those are the trades that I'm potentially looking at. Now, the one challenge that I do have is I will be leaving tomorrow morning fairly early. So I actually hoped to get in bed a little bit earlier tonight. So there is a chance that I might not be around for NFP. I obviously hope that I will be, and I hope that I'm fresh enough if I do. But if I go to bed early, obviously you guys have the preview, and good luck with the event. So let's hope we get some big deviations. As always, any questions, just shoot them over.